This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thank you for joining us. My name is Bruce Norris, and today our special guest is Erik Hernandez. Erik has been with Lee & Associates in the commercial real estate division since 2000 and research prior to that since 1994. He specializes in industrial real estate, and we've had Erik on a number of times before, and he's actually our go-to person for the commercial world. So, Erik, welcome back to our show.
Bruce, thanks for having me. It's a pleasure to be back. It's been too long.
It has been a while, and it's one of those things that it's been going really well. So let's talk about there's different segments in the commercial world. So there's hotels and there's storage units, and you're in the industrial space, basically. Is that
industrial real estate for the Inland Empire? And that has really been the bread and butter, for development for many of your listeners. If you drive up and down the freeways now, you'll see these big concrete tilt-up structures being tilted, new buildings getting built, like the QVC building over here in Ontario near the airport, or maybe one of the many Amazon distribution centers that have recently been built. And that's what we specialize in, and that's what I specialize in. The other segments out here are, call it multifamily or apartments.
Right.
Retail, of course, and then office. And multifamily was really the first to come back after the recession, and then industrial really came back like nobody's business. And that's really been, the leader out here as far as the commercial industrial arena goes between industrial, office, and retail. It's been industrial, the leader by far.
What's been interesting about that? I mean, residential just got killed, 2008 and all the way to 2012. It was pretty much a depression. And you had a lot of stuff that felt like it could go really wrong with the commercial world too. And for some reason, it seemed like they avoided the worst of it. Is that just an amateur's perspective because I'm not a commercial guy, or is that kind of what happened?
Most of the owners out here did. And, there was an interesting thing. I remember sitting with several people that had put together funds, opportunity funds, right, in, call it 2009, late 2008, 2009, early 2010.
Yeah.
And a lot of those principals had lived through the 90s, early 90s, late 80s, early 90s, to tell about it after the last go-around. And at that point in time, the government took back a lot of properties. They created the Resolution Trust Corporation.
That's right.
The FDIC, the Savings and Loan Crisis, and a lot of banks failed, and a lot of assets were taken back. And I think what's forgotten in a lot of this is that this go-around, the liquidate mantra was, or at least attempted to be avoided at all costs, and that was the mission of Sheila Bair. Remember the old head of the FDIC?
Yeah.
And they had come out very early on and said that they wanted to avoid a repeat of the 90s. And, people like Peter Schiff were kind of critical at the time. It was going to be blend and pretend, blend and extend, but that's what happened. And so there were a few key sales that happened that were really forced sales because the debt had come due and it couldn't be renewed. But those sales wound up being bottom of the market sales. They were a little bit distressed, but they were not, bank takebacks or liquidations. They were just kind of forced sales because the debt couldn't be renewed. But there were ready and willing buyers at that point that were willing to take on those assets. And, for about a good year and a half, there were 3 active buyers that were, your first phone call you'd make if you had something that was interesting at that time.
What's interesting about the residential side, I'm trying to just stretching my memory a little bit, but in 1995, there was actually a rise in trustee sales, but a rise in defaults, but a lowering of trustee sales, and the lenders had just stopped foreclosing in 95 and kind of on their own. And there was legislation passed that said if people are 100 days late, you have to put them in foreclosure. you go forward to 2008 to 2012, it was exactly the opposite. We just said, it's okay if you're behind.
It was different. I still see commercials. I think I saw one this morning on CNBC, or I forget what news station it was, or channel. It was the California, save your home if you're in trouble.
Yeah.
It's 2017.
Yeah, I mean, you'd have, I guess you'd have a small business still remaining, but that's still the sentiment, I guess. And that's really what my point is. It's going forward. Do we have we sort of discovered a new way to solve a problem without a lot of damage? So the next time we have one of these, we now have a new playbook. We probably won't bring out the 90s playbook. We probably will bring out the one we just used. Yeah,
if people are capitalized enough. It's interesting. Out here, the Inland Empire really led the country, in coming out of this great recession. It's interesting. When I started as a market research intern, working the numbers back in, it was April of 1994.
So really in the middle of not such a good time.
That's right. There were people, in fact, that were still leaving the commercial real estate business from the brokerage. And if they had, the mantra at that time was stay alive till 95.
Okay.
And actually, probably some people say maybe it really was 96 in hindsight. But I remember sitting in some early sales meetings in 1994, that summer, and some of the top real estate brokers in our office at the time were debating on whether or not it was time to start chasing land listings again. Because, if you had a land listing in 1992 or 1993, or even early 94, not very many people, in fact, almost no one was buying land.
No, it was
time.
Worthless.
And the debate and consensus seemed to be that it felt like it was about getting ready time to go after it. In fact, I know one individual that actually did not chase a land opportunity would have been 93 that, in hindsight, probably would have been a good one to chase.
Yeah,
that's... In fact, I was told never turn down a land listing again.
Sometimes it takes a contrarian to make a fortune. We had, speaking of land in the 90s, we had a call from the city who had a 50-lot subdivision they had to take back through tax default. And they actually were offering to give us the land free. 50 buildable lots, but I had to build on them inside of a calendar year. And I was able to buy houses in the city for half of my construction cost. So what was the point? So yeah. It sounded like a good deal, but it was okay. If I have to build on them right now, it makes no sense.
There was a moment of time, in 2009, 2010, where land was overpriced and free, right? Because the market had taken such a hit. And once we got to about, certainly on the west end, and when I say west end, I mean Ontario and in and around the airport area, once we hit a discount of about 40% to 50%, that seemed to be the consensus that was it. And then we stayed there for a while, and then we clawed our way back. And we are now back and surpassing the valuations that we saw in terms of peak valuations in 2008. No. And interestingly, on the bigger buildings, the rental numbers have actually surpassed the last records that we hit, and the land prices are now about there. But the lease rates passed before the land prices because the land prices are a 2-year lag by the time you buy the land and build the real estate, because the cap rates compressed compared to where they were at last time. The cap rates now have been sub 5 and in some cases sub 4%, depending on the real estate and when the leases roll over and things like that, and the timing of the deal.
So how does this compare? Okay, let's talk about, now you said 2008. 2008, was that considered the peak in the commercial world at that point?
Yes.
Okay.
Yes, that was the peak. Yeah.
Okay. So in 2008, were you looking around saying we're in a bubble? And did it feel like that? And does it feel like that again?
So 2008 definitely felt like one too many drinks had been poured at the after party.
Okay.
And when the money shut off fast. In fact, actually, you could see it start to happen actually in the summer of 2007. Actually, I remember, in fact, I'd never forget it because my youngest son was born on August 16th, 2007. I believe it was the day before August 15th when, the guy Kramer on CNBC.
Yeah, when he went nuts.
He went nuts, remember?
That's
he was
right.
screaming to open the discount window.
They have no idea what they're doing.
Someone can fact check me on this. I'm pretty sure that was August 15th, 2007. And that was a full year before, the money just got completely turned off. But you could see the things coming through. Might have even been earlier that year. But, it's starting to happen. This time around, it feels very much more driven by supply and demand. I wanted to share with you a couple of numbers for your listeners.
Okay.
So I went back. These numbers are from 2012. And when I say Inland Empire West, I'm kind of talking Fontana, Ontario, Rancho Cucamonga, Chino, what I would call Mariloma, which is really now Eastvale and Jurupa Valley.
Okay.
And then when I say Inland Empire East, we're talking Rialto, Colton, San Bernardino, Redlands, Riverside, okay?
Okay.
So since 2012, and if you include everything that's under construction right now, at the end of 2016, we had about 22 million square feet of industrial real estate under construction. If you include that along with all the construction completions from 2012 to now, that's 102 million square feet of new industrial real estate that has been built in the last 7 years.
Wow.
It's amazing. That's bigger than some, smaller metro markets across the country.
I don't know how to relate to that. So let's say 102 million is how...
I'm going to give you one more number.
Okay.
Here's the number you'll be interested in.
Okay.
If you assumed about a 45% coverage, building to land, that means that we absorbed about 5,300 acres of land.
Okay. Wow.
It's actually 5,238, but about 5,300 acres of land.
This 102 million square foot that was added represents what percentage of, let's say, the whole?
So the entire base between the east and the west now is about 540 million square feet.
So that's really significant, adding 20% of your entire forever stock in 7 years.
Right.
Wow.
So it's a big percentage of what's out here. When you zoom out and you consider the ports of L.A., Long Beach, and we're really a submarket of the entire L.A. basin, L.A., Orange County. If you factor that in, the entire base is really more about, I believe it's about 1.6 billion square feet now.
There's a term I noticed on one of your reports. There's a vacancy rate and there's an availability rate and they're different.
That's right.
So does that mean the availability includes what's under construction?
It does. The availability rate includes three things besides anything that would be vacant. So it includes anything that's physically vacant. It would also include anything that's on the market and that's either occupied or it could be on the market for sublease. Sometimes you get a big building that comes on the market for sublease. So we would include that as available, but it's technically not vacant because someone's still paying rent on the space.
I got it.
And then it would also include buildings that are under construction and that are available. So in a market like we're in right now, depending on the size range you're looking at, especially on buildings, over 300,000 square feet, 500,000 square feet, it could be that 20 to 30% of the buildings that you're looking at are under construction.
Right.
If you want to go look at 10 buildings, 3 or 4 of the buildings in your search would be buildings under construction. And you'd have to look at those because the market's so active that there could be multiple deals working on each of those buildings simultaneously. Right.
It's sort of like the rent price isn't even locked in, right? It's sort of negotiable.
The landlords have expectations on the rent, but you get there have been situations where someone's negotiating on a building and someone comes in and swoops in and takes it and it's gone. And if you've spent 3 months with structural engineers and trying to figure out how to make that building work and you didn't sign a lease on it, you're back to the drawing board.
Yeah. Now, one thing I noticed was it surprised me that when you looked at the share of sales that were occupants versus investor, I guess I would have thought the occupant would have been the dominant player, and it's not even close.
The investors, by far.
By far.
Yeah.
But why? Well, at that cap rate, why? What's the urgency there?
So if you lift up the curtain and look at the wizard behind the curtain,
right?
The wizard operating the levers are often big institutional money people. So some of the biggest investors are teacher retirement funds, pension funds, CalPERS, the Public Employee Retirement System, CalSTRS, State Teachers Retirement System.
Right.
A lot of other state teachers like to buy in California, Washington, Ohio, New York. It's big. And then along with that, you get your life insurance companies like New York Life and Principal and Prudential and on and on. And, those firms have literally billions of dollars to allocate and invest. And, they take a percentage of what they put out and they put it into real estate.
What about foreign investors? They're a pretty good sized participant in that space as well.
They are, yeah. In the last few years, there was a big push out of Australia. There were some major funds and institutions that came from Australia. A couple of those have continued to grow. A couple of them decided to sell some pretty substantial portfolios, but you continue to see that. Sometimes those are exchange driven, just depending on where the money is going. One of the stories that precedes me that I always heard about you may have seen this too, back in the late 70s and early 80s, a lot of real estate developers were based out of Canada.
Right. Well, it's interesting. Canada has sort of added a little bit of, and I don't know if it's commercial real estate, but I do know it's residential, that if you have, let's say you're a Chinese investor, you have to pay a 15% premium to buy real estate in Canada. So did that affect anybody saying, well, I'd rather buy in the United States then? I'm just curious.
That could be a factor. I don't know the details on it, so it's hard for me to speculate on that.
Okay.
But I like to have I'm a numbers guy like you, right? I like to have the data in front of me instead of just shooting from the hip. But the hard things that I've seen in terms of actual transactions and deal flow, one other thing I've seen is, Japanese banks have really cheap money.
Oh, yeah.
And they've partnered with other institutions to place that money in California and U.S. real estate.
Okay.
Because their cost of funds is
negative.
So low. It's negative, right?
It is.
Banks get penalized. I had, about 2 years ago, I had to have someone explain to me what a negative interest rate was.
Yeah,
I didn't get it. I literally, and I consider myself bright sometimes, not all the time, but I had to literally have someone explain it to me, a banker friend of mine, and they get charged for keeping too much money in the bank. You get charged for keeping your money in the bank.
Right. They
have to send it out.
One of the hottest selling items in Japan is a home safe. So people can, instead of losing money with their savings in the bank, they just keep it at home.
Yeah. We've been Americans have actually had that for quite some time. People are finally realizing it. But you put your money in the bank, and CPI is 2 to 3% a year, right?
Right.
And your money is getting zero.
Right.
Right.
Yeah.
So really, your money is losing its purchasing power over time by sitting in the bank.
What's interesting about when you say CalPERS or the variety of family of those, they're supposed to be clipping along at 7.5% yield, and they're buying industrial buildings at a 4 cap, let's say, at a pretty good size premium in price. So I'm wondering, if interest rates change, what happens to cap rates historically? Are you familiar with that?
Sure. So there's typically a spread between, probably the metric everyone keeps an eye on the most, besides, LIBOR, is really the 10-year
okay.
Treasury. And so like for example, you might remember when Ben Bernanke had his taper tantrum. Do you remember that?
Yeah.
And I think that was about May of 2013.
Right.
And at that time, I mean, remember, this is almost 4 years ago now, right?
Right.
In fact, I pulled up a chart here. Here, I can actually tell you, because I wanted to go back and see what that actually was. Yeah, so on March 31st, the 10-year was around 1.67%. And over the next, on December 1st, it was about 3%.
Right.
It went up almost 140 basis points in 9 months,
Mm-hmm.
8 months. It was massive, and the market, couldn't take it anymore, and it finally relented, and then the interest rates came. The 10-year by January of 2015 was back at 1.67%.
Yeah.
Right.
So this is a good question going forward. The industry in general, is it concerned about a recession in the next couple years? And what's the impact if that happens usually to commercial real estate?
So recessions are always hard to predict. What's that old saying that economists have predicted 9 out of the last 5 recessions?
Yeah.
Something like that.
Yeah. Not a very accurate prediction.
It's been humming along so well for so long now that I think there is a feeling that there may be a pause that refreshes. There's so much money chasing real estate, and the buildings that get built, they seem to get absorbed often before completion. There is a technology thing that is happening that is driving a lot of this. A lot of these big buildings, you build a 1 million square foot building, you're taking down a lot of land at a given time, and 50 acres here, 50 acres there, it adds up pretty quickly, as I shared with you earlier. But there's this huge e-commerce thing that has just completely changed the way you and I and the whole world buys things, right? Especially on Amazon. I mean, I love Amazon. I can zap something and I can have it in my door. Sometimes I can have it same day.
Yeah, groceries being one of them.
It's amazing. And so, on the one hand, a lot of this retail is now winding up in these warehouses, and it's delivered by truck to your front door. What that means is that these old line retailers and a lot of these malls, they're going to have to rethink how they exist, right? Companies like Sears. Oh, yeah. They have to rethink how they exist going forward.
One of the craziest examples of that, we've got about a minute and a half left of this segment. There was a mall that was obviously closed. It had graffitied everywhere. And what they had done is convert it to a drone racetrack. And so this massive mall in Minnesota was now the world stage for drone racing.
I saw that on ESPN, I believe it was. Yes. So the Drone Racing League, that's right.
Yeah, so is that the next highest and best use for your closed malls? Unbelievable.
That's wild. Yeah.
One of the things that, and we're going to continue this in the next segment, there's a report, and again, I'm not my world, I'm not a commercial guy, but I read some reports, and there's a report that's typically put out every year for projecting going forward. And it was kind of surprising to me. It talked about financing, and so they had a track record of what the sentiment was for the next year in 2012, 13, and all the way. 2017 was way higher than any of the years, and the term that they used was more rigorous qualifying for the entire segment of commercial real estate. And I just thought, wow, that's a little scary, because it was way higher than even 12 and 13. It was 40-some% that they thought it was going to be more rigorous. Erik, at that, we're going to close this segment, and we'll pick up in our next show. We've been speaking with Erik Hernandez, and can I give you your phone number out?
Absolutely. In fact, I'll give you probably the best line to use would be 909-373-2707.
All right, Erik. Thanks a lot. We'll see you. Bye-bye.
Thanks, Bruce.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.